Welcome, dear students. Welcome to Chapter 5 on Fundamental Analysis, Financial Statements, and Ratio Analysis. Now, this isn't going to be as exciting or as intriguing as the previous chapter. My apologies. In fact, it can be kind of tedious and dull. The more we know about accounting, the better we will be able to use the language of accounting to help us invest. But having said that, especially if you've taken accounting, you know it's not the most exciting topic in the university's catalog of things we study. In fact, we start with a joke. Remember, we're going to insult everybody by the end of the semester. If an accountant's spouse cannot sleep at night, all he or she really has to do is turn to their spouse and say, "Dear, tell me about your day at work." Okay, I apologize in advance. I took accounting a million years ago, well, about a half a million years ago. And after I got out of the two class, I did well, actually, believe it or not. But I just said to myself, there ain't no way I'm going to do that for a living. Oh. But the cool thing is, as investors, we don't have to do it. We let the accountants do the work, and we use their fruits of their labors. But as we said, the more we understand accounting, the more easily we'll be able to use that data to make informed, prudent, long-term oriented decisions. So let's get started on slide number 2. There are 3 financial statements that publicly traded companies must publish every quarter. And they are sent to the Securities and Exchange Commission, and we'll see the website that we can download them from. But they're also available through the various websites that you've already used, Morningstar, Yahoo, CNBC, and the like. The 3 are the balance sheet, the income statement, and the cash flow statement. Now, here's where we diverge from the financial planning class that you might have taken, where we called the cash flow statement the statement that we use to identify our income and our expenses. The accountants cringe when we use that term in personal finance. To them, that's an income statement, or what used to be called the P&L, profit and loss. So we're going to see that you're going to have to throw away, if you remember the cash flow statement that you did in Business 121, Principles of Money Management, you're going to have to relearn that. That's the income statement in our class. The balance sheet, though, is the same. That's the net worth statement, you might have called it. We take our assets and our liabilities, subtract the liabilities from the assets, and what's left over is the stockholders' equity. In the personal finance class, we called it net worth. The income statement is what we called the cash flow statement in the personal finance class. We take our income coming in the door and then subtract out all the gastos, all the expenses, and then we're left with the net income. Now, what's this cash flow statement? Well, this is something that accountants use to show you what happened to the checkbook. Because as we're going to see, the income that we report to the IRS is not always, usually not, the amount of money that actually we made, the cash flow, or sometimes you hear people use the term free cash flow. So the cash flow statement shows us what happened to our checkbook. Where did the money move within the system, within our company? The more we know and understand accounting, the better we will be able to understand and analyze the companies we're researching. Fortunately, we don't have to perform any of the accounting. So let's concentrate on each. The first is the balance sheet. As we said, you take your assets, anything that the company owns that has value, and your liabilities, also known as debts, and you then find out what's left over, the equity, the net worth, shareholders' equity. And the accountants use the kind of a unusual way people think of these three elements together. They say assets equal liabilities plus equity. But most of us think of assets minus liabilities equal equity. It doesn't matter, they're the same formula. But why do they do this? Well, it's for the very same reason that it was still called the balance sheet. Because before computers, on one sheet on the left would be all the assets, and then the sheet on the right would be the liabilities and the equities. And those two must balance. The total assets must balance what's on the right side, the liabilities and equities. Well, because of computers, we don't do that anymore. We just do it. We just put assets on the top and then the liabilities and then equity at the bottom. Now, as we said, the accountants, I think we said this back in chapter 1, maybe not. The accountants don't think in terms of short-term, intermediate-term, long-term. To them, everything is either current assets, what we would call short-term, and long-term assets, what we would call intermediate and long-term. So current assets are any items that are going to be used within a year. Everything else is long-term assets. For that, we find that it's a little different than how we in finance and investments think of assets, but that's how it's done. So let's take a look at the example. We're going to be using Sprouts. You might shop there, Sprouts Farmers Market or Farmers Market, Sprouts Farmers Market. So let's see where that puppy is. Where is it? Well, of course, they're on the website, so you can download them. And you can also check, the funny thing is you go to different places, they will look differently. The mother lode, of course, is Edgar. This is the guy, I forget what Edgar stands for. But all publicly traded companies are required to file their financial statements here on Securities and Exchange Commission system called Edgar. But I don't want to use this because it doesn't look as good as if we just queue it up on the hard drive here. So let's go. Where is it? Where's the balance sheet? There's the balance sheet. So notice that the balance sheet will also show you years past, and you can also ask for it quarterly also. We're just looking yearly, just to make life a little easier. And so here are our assets, and notice that they separate them into total current assets, and all other assets. So these are the assets that are going to be used up within a year. And some of you may or may not know what some of these items are. Accounts receivable. Notice this system, they put the short-term investments and the cash and cash equivalents together. That's why you see just blanks here. Some places break them out into cash and cash equivalents and then short-term investments as a separate entity. What's accounts receivable? Some of you know. Yeah, that's money that's going to come in the door. It's not here yet, but it's coming in the door. And then inventory, what we have to sell. And then other current assets, whatever those items happen to be. So that's our total current assets. But the corporation also has plenty of long-term assets, long-term investments, plant, property, equipment. What's goodwill? Well, it's hard to describe, and I have a hard time understanding it too. Just the fact that there's Sprouts Family Market, that's worth something. The brand name and other what are called intangible assets. You can't really put your finger on them. They're not hard assets. They're the fact that Sprouts Family Market is in business and has a great name. That's an asset. So there's the total current assets. Now let's go down to our liabilities. So again, they break it up between current liabilities, things that must be paid within the next year, accounts payable, and that includes payroll, and then any long-term debt or short-term debt that is coming due. Not long-term debt that's not due yet, but anything that's coming due, and then any other current liabilities. So there's the total current liabilities. And then we have the long-term liabilities. Long-term debt, think of it like a mortgage, and a few others. So there's the total liabilities. Now notice, total assets minus total liabilities will give us total stockholders' equity. So assets minus liability equals equity. The accountants would say assets equals total liabilities and equity, whatever. It's the same idea. And we can track it through time. Now, for some reason, I can't move sideways. But this goes all the way back to 2019, yeah. And I don't, for some reason, I guess I could just pull it, I could move the whole thing over. That's what I'll do. And we can see that Sprouts has been, increasing their assets very smartly over the years, and also increasing their debts over the years too. Notice that, well, actually, they got rid of a lot of debt. They took on a ton of debt in 2017 and 18 after the tax act, the Tax Cut Act of 2017, and we see that their stockholders' equity has been doing pretty well. In other words, Sprouts has been doing pretty well from an asset standpoint. That's the balance sheet. So let's get rid of that guy and go back to the presentation. And now the income statement. This is going to take the company's revenues, subtract the expenses, and we have to pay everybody. And then what's left over is called net income. All right, so let's take a look at the income statement for Sprouts. Here it is. And let's move over because we see that their income has been sort of kind of bouncing up and down. I mean, their revenue, I should say. Revenue has been bouncing up and down. You see, they did gangbusters during the pandemic, and then last year they actually did pretty well, 2023. So that's the top line, the revenue. This is the money that's come in the door. Then we take the cost of the revenue. Sometimes you'll see it written as cost of goods sold. Well, obviously, Sprouts is a supermarket, right? They don't make the stuff that they sell. They bring it in and sell it. And so that's the first expense. And then we have what is called the gross profit. But then we have all these fixed expenses that we have to pay for. They lump them under SG&A. Remember SG&A from chapter 3? Yeah. And then any non-recurring. So sure, these were all the items that they sold, but they got to pay the rent, they got to pay the employees and the utility bills and all the other things. And that's the operating expenses. Notice that they don't really have any R&D, research and development. It's a supermarket. So their total operating expenses were a little over. Oh, by the way, all these numbers you have to add 3 zeros, right? See, all numbers in thousands. So actually, they didn't sell $6,837,000 worth of stuff. They sold $6,387,000,000 stuff. So their total operating expenses were a little over $2 billion. So they had an operating income of $350,000. Oh, but wait a minute, that's not the bottom line yet. They might have some other income or expenses. In this case, nothing. Prior years they had a little bit of extra income, but now here's what's called earnings before interest and taxes. So this number says, okay, this is how much they made before they had to pay their interest expense, which for Sprouts is pretty small. It's considering they sell $6 billion worth of material of groceries every year, their income expense is actually pretty small. And now here's the income before taxes, and then up there are the taxes. They got to pay the IRS their taxes, and whatever states they have to pay taxes to. So now we finally get to the bottom line. Well, maybe not. There might be some other extraordinary items or effects of accounting changes, but these are typically going to be zero. And we specifically chose Sprouts because it's a fairly straightforward balance sheet and income statement. And so the bottom line. So you might remember hearing that when you were listening to the earnings calls in chapter 3, top line growth, bottom line growth, right? The top line being the total revenue coming in the door, the bottom line being the net income. Cool? And of course, I think I showed you that Sprouts has been doing a pretty good job. Sprouts is actually a pretty well-run company. You notice that their income is bouncing around a little bit, but for the most part, they're pretty healthy. Sprouts ain't going to go bankrupt anytime soon. So let's get rid of that guy. And now, what we find when we learn more about accounting is that some of the income and expenses are not always received or paid for in cash. Huh? Well, yeah, the net income that we report to the IRS may or may not be, usually not, the amount of money we actually made in the door, the amount of money that came into our checkbook last year. And that is why there's the cash flow statement. The cash flow statement, or sometimes called the old saying, you might hear some people say, statement of cash flows, shows us where the money went. Because in some of the cases, and especially if you've taken accounting, specifically the biggest one being depreciation, the IRS says, look, you built this $2 billion factory to build whatever. You can't expense that all in 1 year. You have to depreciate that over 25 or 30 years. So you put out the money for the factory, however you did it, whether you paid for it in cash or borrowed it from bonds or whatever. But now you only can expense a certain amount every year. That is called depreciation. But you didn't write a check to depreciation. You already bought the thing. Now it's just simply going down in value, and you're allowed to use that depreciation entry as a way to reduce your net income. But it didn't reduce your cash flow. The cash still came in the door. So it is very typical for the net income and the cash flow to be two different numbers. And there are others, and we're not going to get into these in detail because it can get pretty, I don't say not pretty scary, but it's something that you would learn more about in an accounting class. And again, the more you know about accounting, the better you're going to be able to understand the numbers that you're using to identify your companies. So here's the statement of cash flows. Notice that it starts where the income statement ended. In other words, okay, this is how much money is the net income. Fine. What do? The first thing we do is we add back depreciation. Sprouts was able to reduce their net income by $265 million. But they didn't write a check for that $265 million. That $265 million was just an accounting entry when they told the IRS how much money they made. So you add that back. And then there are things like capital expenditures. Here, Sprouts paid $238 million for new capital equipment. And that's a fancy word for stuff that lasts more than a year. And that's more stuff that they're going to have to depreciate over the next 10, 20, 30 years. Things depreciate at different speeds. Like computers depreciate within 3 years, and cars 5 years, and the like, and factories 30 years. So that money went out the door, even though we did not expense it on the income statement. And so when all is said and done, after we take stuff out and put stuff back in, it turns out that Sprouts' checkbook actually went down in 2023. They had, at the end of the year, they actually had $91 million less than when they started the year before, which again is, for some company that sells $6 billion worth of stuff and they have a pretty healthy balance sheet, they got plenty of money on the books. It's not a big deal. As we're going to see, Sprouts is in pretty darn good shape. So again, take accounting, and then your spouse can ask you, what was your day at work like, dear? And they can go fast asleep. Okay, that was our quick discussion of the 3 financial statements. Where do we find these? Well, as we said, they are in Edgar. Every company must schedule a earnings call. That's one of the assignments in Chapter 3. And what happened in the 1990s, it was of course, the advent of the internet. And the SEC was a little upset because some of the analysts and the like on Wall Street would have uh, prior knowledge. They would see a presentation where they would get information before the general public got it. And so the FCC said, no, 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 we got the technology now. What they do is they say, look, we're going to have you schedule an earnings call, certain day, certain time. And when that happens, the financial statements, which are included in the annual report and the quarterly report, will be made public. They're in the system at 9:30 on August 10th or whatever. Boom, everybody gets to see them at the same time, and that's when you have your earnings call, and they can all go through the materials together. By the way, this is one of my really bad jokes in the face-to-face class. I'll say, now, what's the annual report? 10K. Okay, what's the quarterly report? 10Q. What was that? The students will go, 10Q. And I'd say, you're welcome. It's a sickness. I still laugh whenever. 10Q. You're welcome. Now, one of the things that you will, if you get involved in investing, which you are, you're going to start seeing articles and the like, headlines. Oh, will Procter and Gamble beat their 55 cents a share or whatever? They call them the whisper numbers. Oh yeah, they're going to do. Oh no, they're going to do 56 cents per share. Should you pay attention? No, 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 no. You are all going to be long-term investors, and you'll read. Oh yeah, earnings were expected to be 55 cents a share, and they were only 47 cents a share, and the stock got hammered. Well, la-di-da, that might be a great time for you to buy more shares if you believe that the next 5 years for this company is something that you're interested in. Forget the whisper numbers. This gentleman, Nick Murray, you're probably not going to read his books. They're more, unless you become a stockbroker or an insurance agent or a mortgage broker, they're more geared toward people on the front lines with clients. But he has a great saying. I love it. Wisdom sold separately. Right. There's just too much information. As we saw with the value line. Oh my gosh. It's like it's a sip from the financial fire hose. So yes, don't play the whisper number game, please, dear students. That means you're speculating, trading. And if you do, we wish you a lot of luck. You're going to need it. Slide number 7. So now we're going to turn our attention to financial ratios, the topic of the chapter. The financial ratios are very simple, folks. The relation between two financial quantities expressed as the quotient of one divided by the other. Ratio analysis is the study of these relationships. And what we want to impress upon you is that there's no one ratio that can accurately sum up the overall state of a company. Each ratio must be considered in the context of all the information that you're going to gather. Plus, we also have to look at the competitors, the industry, and the market as a whole. And we're going to see some examples soon. So whereas when we were doing the discounted cash flow and Gordon growth model, it was sort of a yes, no. Yes, let's continue investigating. No, let's go someplace else. That was more of a, red light, green light sort of situation. Not really, because the models might say it's not a great idea, and then we might find something that we really like, or vice versa. The models might say, yeah, this is a great looking stock, and we might say, we wouldn't touch this thing at all. This is more of a stew, because we're going to have a couple of dozen of these financial ratios at our disposal, and we're going to just look at them in context with one another and their competitors and the market as a whole and the industry they're in. And it's a little tedious. Yes, it's a little tedious. It's not as exciting, in my humble opinion, as the discounted cash flow model, which is my favorite model, but everyone's different. So we've already taken a look at many of the common stock, also called market ratios. Oh, by the way, you're going to want to, let's go grab that thing. You're going to want to print out this puppy right here, the financial ratios formulas, and what they do. Up, it's way too small. You can't see it. But they give you the ratio, and they tell you if it's on the income statement, the balance sheet, or both, or something like that. So you're going to want to print that puppy out when you do these ratios. Okay, so some of these we've already discussed, and a few are basically variations of a theme. So let's take a look at the very first one, earnings per share. We looked at the calculation in chapter 3, and we found that it's actually straightforward. And what do you care? You just look it up, right? You just look it up. Earnings per share is the amount of annual earnings available to common stockholders as stated on a per share basis. We can think about each share that we own as a business entity in and of itself, earning 50 cents or 60 cents a share. Earnings per share is a subject of much discussion and speculation, especially with regard to companies that are growing their earnings. Earnings per share is subsequently used in combination with the current market price to compute the most important stock market statistic, the price to earnings ratio. So you could think of your one share of FedEx as a little business in and of itself, earning so much money as earnings per share. And then typically large companies will pay some of that money back to us in the form of dividends. This is all review, remember? Now, here it is, folks, the PE, the price to earnings ratio. You'll see it written as P/E and sometimes PE, which confuses people with physical education. But you take the market price and divide it by the earnings per share, which is a very straightforward calculation. But much ink is spilled talking and arguing and discussing the price to earnings ratio of individual companies as the market as a whole. What does it mean? Well, we saw that typically the higher the PE, the more investors are excited about the prospects for that company, and vice versa. If the PE is very low, investors are not that excited about the prospects. It doesn't mean they're right. That's just that's what the market is saying. Historically, PEs were in 5 to 10, 12, 15. 14 to 20 was left for growing companies. And greater than 20 was just unusual, except during bubbles like in the 1920s, 1960s, and then 80s and 90s, and now with some very expensive companies. The PE also tells you how long it will take in years, assuming no changes in earnings, which of course are changing all the time. The company will earn back its price. And some people say, well, is that important? No, it's not that important, just something to think about. A PE of 3, that means in 3 years, the company's going to earn back the price in terms of earnings. And a PE 20 will take 20 years. It's just something to think about. It's not something that you have to worry about. Or some people get, well, does that mean I should buy it, not buy it? No, it's just something to add to the picture of the company, the story of the company you're interested in. So here are, whoops, there's a mistake. That wasn't supposed to show up. I goofed. I have to fix that. Here are 6 companies that have pretty much nothing to do with one another. Oil company, energy company, internet, bank, drug company, Kellogg's. Kellogg's broke into 2 companies just recently. And then Biogen, which is a biotech company. And that's 12, 24, 21, 12, 24. So right off the bat, we can say, well, of course, these are kind of high-tech companies. They have higher PEs. There's the bank and the energy company and a food company. And, well, the pharmaceutical has a fairly high PE. What we need to do is look at their competitors. And then we get a better picture, or maybe not, depending on the situation. If we look at all the energy companies, ConocoPhillips, British Petroleum, ExxonMobil, Chevron, we see that the PEs are all fairly close to one another. And that's what you normally expect from energy companies. They're not going anywhere. They are, people are saying, whoa, we're not going to be using oil in 20, 30 years. Oh, yes, we are, folks. Oil is too important a commodity. I mean, hopefully, we're going to stop burning it as much as we do, because probably there's a pretty good chance that what you're wearing right now is made out of oil. And so it's such an important commodity, especially for agriculture. It's very important for agriculture. So that would make sense. There's no one company that's sort of making the others look bad. Whereas we go over to the tech companies, and we see that Google's 24, which is pretty high, but they get higher. There's Faceplant. I'm sorry, Farcebook, Meta, as they call it now. Apple, Amazon, and Nvidia. So wow. Notice that Amazon and Nvidia are having PEs that are over 40. Now, is it warranted for these companies to have high PEs? Well, right now, Nvidia is, the market's darling, although last couple of months it's kind of gotten beat up after going up, how many, 300 or 400% in the last few years? But still, it's not as if the demand for their chips is going down. No, every day the CEO gets calls from CEOs of the other tech companies. Got any more chips? So maybe yes, maybe it's not a bad PE. If you remember the example we did back in chapter 3 of Google with a PE, I think it was like 68 or something like that, and GM with a PE of 6. Google went on to go up a couple 1,000%, whereas GM, I say GE, I'm sorry, GM, General Motors, went into bankruptcy. Now, what about these guys? Well, they're all really, really speculative companies. These, not all of them actually. Biogen is pretty straightforward, but Amgen, AbbVie, and Illumina. What's going on here? Well, no, wait a minute. AbbVie, I'm not trying to badmouth them, folks. They're a phenomenal company. They've paid dividends. In fact, we use them, right? We used them in the chapter 4, didn't we? Yes, we did. But that's a pretty high PE. Illumina is not applicable. Why? Because they're losing money. And Illumina is based here in San Diego. Read about them. They're a pretty cool company. The biotech world. I'm sorry. These are the pharmaceuticals. The biotech world, folks. I'm still waiting for this to happen. They were the companies I was suckered for back in the late 90s. The technologies are so cool. They're going to change the world, I think, far more than the internet and the computer phenomenon have changed the world. But we're still waiting, right? You have cancer. Here, eat these strawberries. You want to change your hair color? Yeah, rub this stuff on your back of your hand and you'll change your hair color. And don't worry, it won't make your liver turn into pate. At least we hope it won't. So really, the biotech world is going to just make the world so unrecognizable. We just don't know when, and we don't know who. So it's very speculative. That doesn't mean we should not invest in it. It doesn't mean we should. We just have a whole lot more research to do. So when you see something like this, that's why I put a question mark there. Wait a minute. And an exclamation point. It means it's not something telling us, yes, we should invest, or no, we shouldn't invest. It means we've got to do more research. Right. And then when a company is not making any money, well, that's something we really have to be careful about, right? Yeah, exactly. Why aren't they making any money? What happened? They were making money. What happened? And then we saw these two. Well, Kellogg's is obviously the least excitable one. But this is not too high, considering stocks are pretty high to begin with. If I were the CEO of Hormel, who make the spam, the product spam, I would start an email campaign and I would say, "This is spam!" Because do you know why unwanted email is called spam? It goes back to the Monty Python skit where this woman doesn't want any spam and everything on the menu has spam in it. So there's a little bit of a divergence with the food companies. Whereas, people are not that excited about Kellogg's, but they're kind of excited about Hormel and Kraft Heinz. Now, what about the banks? Again, kind of boring, but JP Morgan, 18 versus Wells Fargo and Bank of America, and a little bit higher for US Bank. So investors are a little bit more excited about JP Morgan's bank than they are than the others. But now the pharmaceuticals. What's going on? Pfizer and Bristol Myers have gone negative after making tons of money. They're now losing money. What's going on? Why is Eli Lilly demanding a PE of over 100? Might it have something to do with a drug that helps people lose weight? I don't know. We need to do more research. Does it make sense? I hope this makes sense. The PE in and of itself shouldn't be just as all these that we're going to go through in this chapter should not be the tail that wags the dog. It shouldn't be the item that says, yes, I'm going to buy it, or no, I'm not going to buy it. It's just something to throw into the mix, and certainly to look at their competitors. Slide number 12. How can we account for the wide PE disparity between different industries and different companies within industries? Again, it is the expectation of future earnings and dividend growth by investors. It's all about the future. Now, this is from the Random Walk Down Wall Street. A gentleman by the name of Jack Dreyfus, who started Dreyfus Funds. They're still around. They got bought by Bank of New York. Take a nice little company that's been, he wrote this in the 1960s, or maybe late 50s. Take a nice little company that's been making shoelaces for 40 years and sells at a respectable 6 times earnings ratio, which was, fine at the time, assuming they were paying dividends and, they're a good company. Change the name from Shoelaces Incorporated to Electronics and Silicon Firth Burners. In today's market, the words electronics and silicon are worth 15 times earnings. This is when silicon chips were just making it into the mainstream. However, the real play comes from the word Firth Burners, which no one understands. A word that no one understands entitles you to double your entire score. Therefore, we have 6 times earnings for the shoelace business, 15 times earnings for the electronics and silicon, or a total of 21 earnings. Multiply this by 2 for Firth Burners, and now we have a score of 42 times earnings for the new company. Right. Of course, today we would replace Firth Burners with cryptocurrencies and electronics and silicon with NFTs, meme stocks, maybe some marijuana stocks, or I don't know, lithium stocks. I don't know. But yeah, it's all about the expectation of the future earnings and potentially dividends. So we're not trying to say you should never buy a company with a high PE. You just have to realize that you better have a pretty high conviction for the future of that company, because if things don't turn out the way investors believe they're going to turn out, the parachutes had better be very large, because there's a long way to fall from a PE of 100 or 80 down to 14. That means the price is going to really fall. Slide number 13. Now, the PEG ratio. This one you'll see reported. It's not that important, but it gives you an idea of the relation of the PE ratio with the growth rate. Typically, companies, investors like to see the PE ratio equal to, similar, close to the growth rate. So you take the stock's PE ratio, and you divide it by 3-year or 5-year growth rate. Of course, that's, you can look the past, or you can extrapolate and estimate the future. A PEG ratio of 1 means that the PE ratio matches its growth rate. Historically, that was considered desirable, since it meant that the PE ratio equaled the growth rate. Anything above 1 was considered high, and now it's commonplace. So next time when you're researching a stock, look, I think it's under statistics for Yahoo. I forget where it is from Morningstar. You'll see, PEG ratio 1.8 or 2.5 or whatever. Check it out. Again, it's just another piece of information to throw into the mix. Now, we talked about in chapter 3 in detail dividends per share because dividends don't lie. That's the measure of how much dividends each share of stock will receive. Annual dividends paid to stockholders divided by the number of shares outstanding. Now, folks, I'm not going to try to scare you or anything, but every single number that you saw on those financial statements may be completely bogus. And sometimes it is. You ever hear of Enron? Before some of you weren't even born yet. The one number that you know is not a lie is the dividends. That's the one number you know is correct. Why? Because they sent you a check. Well, they don't send a check anymore. It's all electronic. So that's why I, yours truly, am a big fan of dividends because dividends don't lie. And there's a book called Dividends Don't Lie, which is not the best book. And now they reissued it as Dividends Still Don't Lie. Again, it's okay. I just love the saying. As we discussed, dividends became taboo during the 1990s. Since that bear market of 2000 to 2002, many investors changed their minds about dividends. You can discuss dividends in polite company now. And many of the tech companies like Microsoft are paying pretty healthy dividends. So even the high tech companies, which are pretty volatile, are now paying pretty decent dividends to their shareholders. Dividend yield, this is again review. We take the dividends per share and divide it by the market price per share. This important statistic allows an investor to compare a company to other forms of investments that pay income such as savings accounts or bonds. Traditionally, 4 to 6% was considered good. And we've seen some companies that are paying 4, 6, 7, some are paying higher. Currently, though, many are not paying any dividends or very, very low dividends. So the S&P 500 index as a whole, as of, what was this, October? Yeah, it's October 2024, is yielding 1.32%. 10-year treasuries are now yielding about 3.77% after many years of very low returns. Well, what happened in 2022 and 2023, and we discussed this back in chapter 1, is the Fed started raising interest rates to combat inflation, but just a couple weeks ago has started lowering interest rates. So we should see probably the 10 years not going to fall that much, but short-term interest rates should fall precipitously because they're still around 5%. They should, by time, we don't know, right? It's called the future, but by this time next year, I wouldn't be surprised to see it down like 3.5, 3.75. Depends. It depends to see if inflation starts kicking up again. I don't think it is. It doesn't mean I'm right. The Fed has 300 PhD economists on their payroll. They know a lot more than I do. So, and they screw up royally. Folks, there's people paid tremendous sums of money to incorrectly predict where interest rates are going. So I don't feel too all alone. Now, the payout ratio. Again, this is review from chapter 3. This is a measure of how much of the company's earnings are paid out to shareholders in the form of dividends. So we don't have to look at it. We can look it up or we can calculate it ourselves. It's not that hard. We take the dividends per share and divide it by the earnings per share. With more mature companies, we would expect to see that percentage a lot higher than younger companies that are just getting started. Take a look at some utilities. You'll see, a much higher payout ratio, whereas more high-tech companies, a lower payout ratio. Why? Because those growing companies retain their earnings, and if you've taken accounting, you know what it's called, retained earnings, to support the growth of the company. Exactly. Now, here are, we talked about book value per share. I'm sorry, I'm getting a little ahead of myself here. This is the net worth of the company. You might think of net worth if you took the BUS123 Principles of Money Management class on a per share basis. We take the common stock holders' equity that was computed and the balance sheet and divide it by the number of shares outstanding. Again, you can just look it up on Yahoo. It's under statistics. The book value per share tells an investor how much assets are behind each share of stock. In other words, if all the assets of the company were liquidated, all the debts were paid off, how much would be left over? It is common for the actual price of a share to be above, far above, the book value per share, since the company is perceived by investors to be worth more than if it were dissolved. And as we said, it's common for it to be far above. Some of the examples we did back in chapter 3, oh my goodness, some of the companies had negative net worth, but they didn't care. They were making their payment. They were making their debt payments. They were still bringing money in the door. And as we saw, a couple of companies were, the market value was getting lower and lower until it might even touch the book value per share, and then you got a serious problem because you're opening yourself up to being liquidated by those private equity vulture capitalists. Now, here I am. The next three are basically variations of the PE ratio. Instead of price to earnings, we look at price to book value. And we said that it's very simple, it's very typical for the market price to be far above the book value per share. Given that the book value per share is often less than the market price, the price to book value per share tells an investor how far above the book value the market is. If they were equal to 1, they would be the same. Very, very rare. Typically 3, 4, 5, 6 or more are not uncommon. And I mean, think about it. I mean, if you own a pizza shop, how much is it really worth if you were to liquidate, sell all the pots and pans and the fixtures, and the pizza oven is probably the most expensive thing in the shop. It's worth more than the assets on the books because it's in business and earning money. And that's the same thing is true for Walmart or FedEx. Because the company's in business to make money, the assets are just something that we keep on the books, and they may not even be worth what the accountants say they're worth, or they may be worth a lot more. It has to do with generally accepted accounting principles, which not necessarily have anything to do with what's the reality of the marketplace. Slide number 19, same idea. Instead of price to earnings, we have price to cash flow. Well, why would we want to look at the price to cash flow? Well, as we said, cash flow often differs from earnings per share for several reasons, but the most common is depreciation, but there are many reasons. And what you will hear is people say, well, these are good quality earnings or these are poor quality earnings. And you go, what? What are you talking about? Well, during the internet mania, many companies were reporting record earnings. But at the same time, their cash flow was negative. Their cash flow was going down. The checkbook was going down. The statement of cash flows, the cash flow statement was showing hemorrhaging, money leaving the doors. What was going on? Well, here was the dynamic. Some of you weren't even born yet, so that's okay. It's history. Throughout the 80s and 90s, telecommunications, cell phones and the like made awesome unbelievable advances. Right now, every year they talk about one more thing that the iPhone can do, then one more thing that the Samsung phone can do that nobody uses. But these advances were just head and shoulders just way above what's going on now, and so they needed equipment. They needed new equipment. Well, there was a company called Lucent Technologies. It used to be part of Bell Labs, which was owned by AT&T. AT&T spun them off. It was Western Electric. Well, Bell Labs and Western Electric were basically the same company. Bell Labs was the research folks. These are the people who made the transistor back in 1949. They also made Unix, a few other things. And Western Electric was the company that actually manufactured the telephone equipment. Best telephone equipment in the world. So they were spun off from the old AT&T, called Lucent Technologies. Well, there are all these startups trying to get into the world of telecommunications and cell phones and the like. And they go to Lucent Technologies and say, we want to buy $2 billion worth of your equipment, but no bank will lend us the money. We don't really have the money. Will you sell us the equipment and then we agree to pay you $100 million for the next 20 years or whatever? And Lucent Technologies was very happy to do this because it meant that they could record the sales as earnings. So they were having record earnings, but the money wasn't coming in the door. They were just booking. You hear people say, we booked those earnings, we booked those sales, because they sold the equipment and the money was going to come in over the, no, it wasn't, because these companies, most of which disappeared in the .bomb, instead of the .com revolution, the .bomb deflation of the internet bubble. And so, well, Lucent Technologies gets their equipment back, but now it's obsolete. And Lucent Technologies almost went through bankruptcy because of this. So that's why you'll hear people talk about good quality earnings, where this is good cash flow coming in the door, or poor quality earnings, where, yeah, they might be booking the earnings, but they're not getting the cash in the door. And then the last one for tonight is the price to sales ratio. Same idea, but instead of looking at price to book, price to cash flow, price to earnings, we look at price to sales. We take the market price and divide it by the sales per share. During the internet mania, many analysts were using price to sales instead of price to earnings. Why? Because many of these new high-flying technology companies never generated any earnings, didn't look like they were going to generate any earnings for the next several years, and of course, they're all gone. Cool. So now these were review and a few new ones. These are the market ratios, the common ratios. In our next presentation, we're going to actually do some calculations. And so we want you to get your 99-cent calculator, get that formula sheet, and you don't have to print out the income statement and the balance sheet. It might be a good idea to do so, because we're going to actually do some of these. And once you do a few of them, they're pretty straightforward. The trickiest part is finding the number on the income statement or the balance sheet. But in our assignment, we're going to ask you to do 12 out of 30, not quite 30. But we hope you do at least 2 from each category. So we'll see you in our next presentation, and we hope you haven't fallen asleep by now. Okay? Thank you so much for being in our class. We're so proud of you. Think of how much you've learned. You are awesome investment gurus, dear students.